Hi there, my name is Ernest and I am the Gen Z analyst. Welcome to my channel. In this video, we are coming to learn how to build the DCF, or what we call the discounted cash flow financial model. If this is your first time on my channel, please subscribe to the channel and consider liking the video if you find it useful, and also consider sharing the video with others so they can also benefit from what the Gen Z analyst has been sharing here on YouTube. Alright, so let's get right into business. So in this video, we are coming to learn how to build a DCF model from scratch. In my previous videos, we have learned how to build the three-statement financial model, which serves as the basis for building all other financial models. So in this particular model, you would realize that we are actually going to apply the principles we learned in building three-statement financial models to the building of DCF models as well. So keep your eyes on and let's get back into business. Now in this particular video, as I said, we are going to apply some of the principles of three-statement financial model. However, I'm coming to bring out some salient tricks, tips and tricks that will actually that would actually make your work flow a lot faster. So don't skip any part of this video, and then we are going to enjoy every single step of the way. Alright, so first of all, let's look at the setup. That's what we're going to look at. So let's look at the DCF model setup. Now when you scrolling down, you realize that I have my historical financial statements. So I have my statement of profit or loss, or the income statement. I have the statement of financial position or the balance sheet, and I have the statement of cash flows. So as you can already see, the three financial statements are already in play here. So we are going to use these to forecast our cash flows and then discount them into the present. That is what the DCF model is all about. First and foremost, I'm going to have the heading here, discounted cash flow model, and I'm going to put it there, and let me bolden it. So very good. And then I'm going to insert some color here, fill color. I'm going to use this darker blue here, and I'm going to change my font's color to this white. Okay, great. Now I'm going to input a check here, but that is not going to happen it's going to happen in a jiffy. So we have that, and then I'm going to indicate that all here, and then I'll indicate that all figures are in USD Alright, so I'm going to come here, and then I'm going to indicate that all figures are in millions of USD, that's US dollars. So all figures are in USD, and I'll come here and indicate my years. So I'm going to have 20 so my historical financial statements are from 2020 through 2022. So what I'm going to do is to pick this and add one. So I have that. So I'm going to pick it and then forward it to Control R, and my historical financial statements, I'm going to do it from 2023 to 2028. Great. Now I want to indicate that this is actual period and this is forecast. So but first of all, let me come here and then paint it and convert it to white. Great. Then I want to indicate that these 3 years are for the historical years, and then from 2023 to 2028 are forecasts. So what I'm going to do is to utilize, I'll select the 3 years for my actual financial data, and then I'm going to hit Control 1, and I'll go to Custom. I'll select this 0 here, and in quotes I'll write A, indicating these are actual years or actual financial years, and then I'll come select the forecast periods, hit Control 1 again. I'll come to Custom. The 0 here, I'm going to convert it to, in quotes, I'm going to write F, which means they are forecasts. So I'll close my quotes and I'll hit Enter. So at this point, we know that these 3 are the actual financial years, whilst the rest are historical. Now I want to change the color there just so I can see it more clearly. So let me use this color here. Good. So those 3 are my actual financial statements, and then I'm going to have 365 days here, 365 days, and I'm going to copy this across, Control R. So this means that in every of the financial years there are 365 days. So that is the implication, or that is what we are going to put there. And then for here, I'm going to have what you call scenario switch. I'm going to have scenario switch here, and the scenario switch, before that, let me come here and then I'm going to name this sheet cases, and then so I'm going to have cases here, and for the cases I'll have a base case. So I have a base case, I'll have an upside case and a downside case. Alright, then I'm going to assign values to these cases. So for the base case, I'll assign 1 and then 3 for my downside case. So these are the scenarios that we are coming to build. So in case a particular scenario changes, what will be the effect on our model? That is the reason why we are doing all this. So it is a kind of sensitivity analysis or a scenario analysis that we are making onto our model to make our model more robust to changing economic circumstances. So we have this right here. Then with these cases, I'm going to have scenario switch here, and I'm going to use a data validation to do my scenario switch. So I'm going to come here and I'll go to data. From data, I'll come to the data tools. Under the data tab, I'll come to data tools and I'll click the drop down menu here, and then I'll click on data validation, and then from settings I'll come to list, and then the source is going to be the cases here, and I'm going to select these 3 numbers. I'll close this and hit OK. So I can come here and then I can select any of the scenarios, whether it's be 1, 2 or 3. So we know that 1 is the base case, 2 is the upside case, and then the 3 is the downside. Alright, now that we have that, I will also come here and I'm going to put share price here. And then for my share price, I'm going to come to my home page here. For the share price, let me put another color there. Sorry, so this is the font color, so let me put it white, and this particular color I want to make it this deep blue here. So that is my share price. I'm going to put it there. We are going to come to that later. So, and then this, to make it stand out, I'm going to paint it like this, convert it to white, and then also I'm going to insert a border around it. Same applies to this, put a border around it. Now whilst I'm doing it, I'm going to be introducing how to use the keyboard shortcut as well. Alright, then the next setup we want to do is the assumptions. So we have an assumptions and drivers, and then for the assumptions and drivers, I'm going to have my cases here. I'm going to have my base case. I'm going to have my upside case. So I'm going to have my upside case there. I'm going to have my downside case, and finally I'll have my active case here. So I have my active case, that is the case under selection. So I have everything set up for me, and we are good to go. So this is what we are going to have. This is where we are going to have our assumptions and drivers. Now these assumptions and drivers are actually so let me copy the formatting here. I'm going to copy the formatting here, and using my shortcuts, let me select the whole of this to the right, and I'm going to paste the format. So to paste the format, I'll use Ctrl Alt V, and I'll select T, which is format, and then I'll hit enter, and that copies the formatting for me. But I do not want my things to be center aligned, so I'll come here and then I'll put it to the left, and then also I'm going to reduce it to 14 or 12. 12 is fine. Alright, so I have that set up. Let me increase it to 14. Okay, great. So I have that set up, and I am good to go. So we have that, and then let me also copy the formatting here. So I'm going to copy the formatting here, and then I'm going to apply it to the other ones. So I'll come here, select everything, and then Ctrl Alt V, I'll select T, and then I'll hit enter, and then it copies it for me. The next one, I'm going to use F4. F4 will repeat the previous action that I undertook. So when I hit F4, it's going to repeat it for me. These are some of the ways to fast track your financial modeling things. So F4 to repeat everything for me. So I'll have my supporting schedules, and then I also have a DCF valuation here. Alright, I think that is all. So this is my setup. So I'll have my assumptions and drivers. I'll have the three statements, or the three financial statements. I'll have supporting schedules, and then I'm going to have the DCF valuation modeling area. Alright, so now that we have set everything up, let us continue to our drivers and assumptions. Now the assumptions are derived from the financial statements. So the first item there is our revenue. So for the revenue, the growth is going to, or the driver is going to be our revenue growth. So our revenue growth rate, put it like that. And then the next one is COGS, and I'm going to do that as a percentage. Now in my previous video I used, so I'm going to do this as a percentage of revenue. In my previous video, the COGS was actually driven, or the assumption was gross margin. In this case, I'm changing it to percent of revenue. Then the next item there, we can actually go there and check. So our next item is SG&A, depreciation expense, interest expense. All right. So we have SG&A, SG&A as a percent of revenue as well. So in financial modeling, you should always set out clearly your assumptions and drivers, as I am doing. So set it out clearly so that anybody who comes across your model will be able to understand whatever you are doing within the model. All right, and then everything should be as simple as possible. The next thing is depreciation, and for my depreciation, it's going to be as a percent, also as a percent of revenue. In my previous video, I did it as a percent of my property, plant and equipment, or PPE, but in this case I'm doing it as a percentage of revenue. It is also correct. So these are alternative ways of doing of modeling your various items within a financial statement. The next one is the interest expense. For my interest expense, I'm going to do it as a percent of my long-term debt. And then the next one is taxes. So it's income taxes, and I'm going to do that as a percent of earnings before tax. All right, so we have that, and then these are for my income statements assumptions and drivers. Now the balance sheet, when it comes to the balance sheet, I need items such as drivers such as the days sales outstanding. I also need the days inventory outstanding, and I also need the days payable outstanding. So DSO, DIO, and then DPO. And then I also need my PPE as a percentage of revenue. So I think that is basically all for now. So we have that, and I'm going to copy this to the other cases. So I'm going to copy this, and then I'm going to paste it here, copy, and then I'm going to paste it here. So we have everything set up for me, and then I'm going to copy the same thing, come here, copy this, and then I'm going to paste it here. All right, so we have everything set up. Now let me reduce the empty spaces right here. Come here and reduce the empty spaces. Let me come here and reduce the empty spaces. Okay, so we have those things set up, all our assumptions here. Now we are going to calculate them. If you want to learn how to master the calculation of some of these items, then I encourage you to look out for my videos on ratios analysis and interpretation. So where I have done an extensive work on ratios, interpretation and analysis in finance and accounting. All right, so with the revenue growth rate, we calculate the revenue growth rate by, so if you look at how we calculate it, you realize that I didn't start from the 2020. So it is actually the current year's revenue divided by the previous year's revenue minus 1. That will give you the revenue growth rate. And since we don't have a previous year for 2020, which is 2019, I'm going to start from 2021 so that I can divide it by 2020's figures. So I'll come here, and this is my revenue for 2021. I'm going to divide that by the revenue for 2020, and I'll subtract 1. So that is my revenue growth rate, 8.4%. I'm going to copy the formula across. All right. Then for my COGS, it's as a percentage of revenue. So Now, before we even continue, I want to freeze the pins. Freezing the pins enables me to look at the particular year under which I am working. I have to be checking whether I am on the right year or not. So I'll come here. I'm going to come here and I'll go to my View tab, and then under the Windows section here, you can see Freeze Pins. I'll expand the drop down. I will expand the drop down and then I'll freeze pins, so that at any point in time when I'm scrolling up, I can see everything at the top here that I want to see. Alright, so the next item here is the COGS as a percentage of revenue. So my cost of goods sold, that is COGS, cost of goods sold, is going to be calculated as a percentage of revenue. So I'll pick my cost of sales or the cost of goods sold, whatever you want to call it. Since it's a negative figure here, I'm going to put a negative here so it can convert it to positive for me. And then I'm going to divide that by my revenue. Alright, I'm going to pick my SG&A. The SG&A is going to follow the same trend as our cost of sales. So I'll pick my SG&A, divide it by my revenue. However, I want to put a negative sign here. Then I can copy this across. So I can copy that across, and then I can actually change this to 60 so it can be correct for me. So I have 65 there, and then my interest expense as a percent of long-term debt. So I'll pick my interest expense here, insert my minus sign, and I'm going to divide that by my total long-term debt as we have here. And then for my income taxes, I'm going to pick the income tax expense from my income statement, and then I'll insert my negative as usual, and I will divide that by the earnings before tax. So I have that there, and then using Control R, I can copy the entire formulas across. Alright, now I've finished calculating that of the income statement items. Now let's go to the balance sheet items. Now the days sales outstanding, or what we call the receivable days outstanding, can be calculated as our revenue or our receivables in the balance sheet. So I'll pick my receivables figure in the balance sheet, and I'm going to divide that by my total revenue from the income statement. So total revenue from the income statement, and I'll multiply that by 365 days as we have it here. So I have 18.25, which is actually days, so I can't have point for days. So I'm going to reduce the decimal places to 0, and then my inventory follows directly under the DSO. So I can come here and then I'll copy this, and I want to change the 60 to 61, put my minus against it because the cost of sales is a minus figure. Sorry. So I'll come here and then I'll change a couple of things here. This is supposed to be 61, however I want to put it to negative, and the days is supposed to be 365 days here, and then I'll press enter. So I have 73 days, and for my DPO, or the days payable outstanding, I'll have my payables in the balance sheet. So I have my payables under the current assets column of the balance sheet, divided by my cost of sales divided by my cost of sales, which is supposed to be a positive figure here, and then I'm going to multiply that by 365 days. Alright, then we have 37 days there. And then for my PPE as a percentage of revenue, I'm going to pick my PPE value from the balance sheet here, and then I'm going to divide that by total revenue from the income statement. So I have that. So this is actually a percentage, so that's 31%. I'm going to increase it to 1 decimal place. Good. So I can copy my formulas across. Now the days are actually in days because these are days. So to be able to do that, I can actually select the entire place here, and I'll hit Control 1. I'll come to special, select my 0 here. The 0 represents the number, and I'm going to open quotes and write days. Close my quotes and hit enter. So I have days here. Alright, so that is it. Now these are our historical. So I've already left this blank. So in order to tell me that this has actually been left intentionally blank, I can come here and then I can put this gray color there to indicate that I intentionally left that blank. So now let's come to our assumptions. So what we usually do here is that we look at economic trends, we look at the markets, we look at what is happening in the economy, and then we make our projections. Or we can actually strike an average. We can use an average figure to make our projections. So from the historical ratios that we calculated here, we can look at it, and then we can make an assumption that okay, revenue has grown from 8.4% to 5.9%. So what's our expectations? Are we going to increase revenue or that? So for our analysis, we are going to put this as 10% here, and so we are expecting the revenue to grow by 10% in 2023 through 2028, right? Then the cost of, now remember, this is the base case. The base case is talking about normal circumstance. So whenever everything is normal, we expect our revenue to grow at 10%, and same applies to all the other assumptions that we are going to make right here. So we have 28% there, and then for this COGS, we are going to have 37%. For my SG&A, I can put it up. For my depreciation, I'm going to have 12%. For my interest, I'm going to have 3.5. For my income tax, I'm going to put it at 29%. And then these ones, 18, put it at 72. And then this is 36. And then for my PPE, let me put it at 30%. So let me format this as a percentage. So I can actually copy this, come here, paste special, and I'll select format, then I'll press OK. So that is actually supposed to be 30%. Alright, so we have our assumptions here. I'm going to copy this to the right. So Control R, and since these are hard-coded numbers, which means they are not referencing any other number, I'm going to, a best financial modeling practice is to put them into the blue color. So you format them as blue in order to differentiate them from other colors. So I'll come to my font color, and I'm going to indicate it in this particular blue here. Alright, so that's fine. Now I'm going to copy the same assumptions that I made here, and then adjust them for my other cases. So I'll come here and then I'm going to paste it here. And then instead of 10%, this is the upside case. So we are talking about, we are being optimistic. So we are saying that for the upside case, we are saying that circumstances will be good, circumstances will be favorable economically. So we are going to adjust our assumptions so that they favor the business in case things turns out to be good. All right, so in case things turn out to be good, then we are expecting revenue to grow at this rate, expenses to reduce and all that. So with that said, for our revenue, we are saying is going to grow at 12% instead of 10. For my COGS, I'm going to put it at 31%. Or for my SG&A, I'm going to reduce it to 21. For my depreciation, I'm going to reduce it to 9. For my interest expense, I'm going to reduce it to 3. And then for my income tax, it's going to remain the same. And then the others are going to remain the same. So I can copy this also to the right. So I'm going to copy it to the right. And as usual, I'm coming here to copy this and paste it for my last assumption, or my last case here, which is the downside case, which is the opposite of the upside case. So instead of 9, I can put 8 here. Instead of 32, I can put 40 here. Instead of 21, I can put 28 here. Instead of 9, I can put 15 there. Instead of the 3, I'm going to put 4 here. And my income tax remains the same. So every other thing remains the same. So I'm going to copy this to the right using Ctrl R. For my active case, that is the particular case that we are going to select, that is going to be a display, that is the active case. So for this, I'm going to utilize the choose function in Excel to be able to do this. So the choose function allows me to pick the particular scenario or the case that I am working on, and then that is going to dynamically update the model for me based on the selected scenario or the selected case. So I'll have my choose. So I have choose. I'll use my tab key to select it, and the first argument here is the index number. The index number is the particular scenario that we are going to pick. So I'll select that and anchor it. I'm going to anchor that using F4. And the first value I'm going to select is the revenue growth for the base case. So the revenue growth rate for the base case. The second one, or the second value, which is value 2, is the revenue growth for the upside case. And then I'm going to select the revenue growth for my downside case as well. Close my parentheses and hit enter. So as you can see, this is 1. And from the scenarios or from the cases, we know that 10% has been allocated for or to the base case. Now let me change it to 2. As soon as I change it to 2, the scenario or the active case turns to 12%, which is correct. And then for my downside case, it changes to 8%. So that is how dynamic the choose function works. So I'm going to copy this formula down, or I'm going to copy this and then I'm going to paste this to the other so I'm going to copy this and then I'm going to paste it to the other cells. All right, now there's a something here to correct. So I'll come here. These are actually days. Okay, so these are actually days, so I'm going to select everything here, and then I'll come here and convert it to number with 0 decimal places. So I'm also going to select the formatting here. I'll select any of the formatting here, and then I'll come here to put it so that the days are displaying correctly. So I'll come here, Control 1, and I'm going to custom. I can select down here and then pick this particular days one, and then I'll select OK. Alright, so that is it. So we have done with our drivers and assumptions, or assumptions and drivers. So we are done. Now I want to do finally is to copy this particular formatting here. So for the empty cells, I'm going to copy that formatting there, and I'm going to paste it onto this. So I'm going to paste, come here and paste it here as well, and then also come here and paste it here as well, indicating that I have intentionally left it blank. So they have been intentionally left blank. So I can use F4 to repeat my last. Alright, so we are done with the drivers and assumptions. Now the next thing we want to do, so always I want to put my scenario at case 1, that's the base case or the normal case. So now that we are finished with the drivers and assumptions, we want to continue to building the income statements or the statement of profit or loss. So to build the income statements, we are going to use the income statement assumptions, which we have already established under the drivers and assumptions. So for my revenue, to forecast my revenue, I'll pick equals the previous year revenue, multiply that by, I'll open parentheses, 1 plus the growth rate, which I'll pick from the active case. Remember, I'm using the active case. So I'll close my parentheses and hit enter. So that is my revenue for 2023 forecast period. For my cost of sales is a percentage of revenue. So I'll select my revenue figure, and then I'm going to multiply that by the COGS as a percentage of revenue as we have under the case, the active case here. I'll hit enter. However, this is supposed to be a negative figure, so I'm going to put minus before the revenue figure. Yes, so I'll copy this formula here, which is the sum of the two, Control R, together. And for my SG&A, it's also as a percentage of revenue, so I have my SG&A expense, and I have revenue multiplied by the SG&A expense as a revenue. So that one too is that. So I'm going to put my minus sign here. Alright, and then for my depreciation expense is the same scenario, so multiplied by 12%, which is depreciation and amortization expense here. I'm going to put my minus sign there. And then I'm going to have my earnings before interest and tax, which is the gross profit. And then we add these two figures. We're going to add these two figures. Since they are negative, adding them will actually reduce this figure. So as I have the formula here already as sum, which is 62, D62 to D65, I'm going to copy the formula across using Control R. So that is our earnings before interest and tax. And then for the interest, this is as a percentage of the long-term debt, which we do not have as of now. So I'm going to leave my interest expense for now, and I'll continue. So we have that, and I can copy the EBT, or the earnings before tax, which is actually our earnings before interest and tax minus the interest expense. So I'll copy my formula across using Control R. And then for my income tax, it's going to be the earnings before tax multiplied by my income tax rate. My income tax rate right there, which I have to add negative. So with that, I can have my net income or the net profit for the year. So I have that as my net profit for the year. So just like that, we are finished. We are almost done forecasting our income statement. So I'll copy everything across using Control R. Now the only item left here is the interest expense, which we are going to get after we have gotten or we are settled on the amount of long-term debt to include within our balance sheet. So let's move on to the balance sheet. So I'll come to my balance sheet. The property, plant and equipment, as I have already said, can be calculated as a percentage of revenue. However, we would have to use the property, plant and equipment schedule under the supporting schedules to be able to determine the right amount to include within the property, plant and equipment. So to forecast the property, plant and equipment, I have already made an assumption that we are going to forecast that as a percentage of revenue. So I'll come here, property, plant and equipment equals, I'll pick my revenue and multiply that by the PPE percentage as percentage of revenue. So I'll pick that and then we're going to have 49. I can copy this across using Control R. Alright, now we have our cash and cash equivalent, which can be gotten from our cash flow statement. So we are going to leave that for the last. We continue to our accounts receivable, and for the accounts receivable, this can be calculated as a change of subject. So as we calculated the days, the receivable days, the inventory days, the payable days, that's the same formula we are going to use to forecast our accounts receivable. So we are just going to turn the formula down. So to forecast my receivable or my accounts receivable or the accounts receivable days is going to be the days which I have already calculated. So I'll come here, select my accounts receivable or the days sales outstanding. I'm going to multiply that by my revenue figure here, which is for 2023 forecast period, and I'm going to divide that by 365 days. So when you make change of subject by making the receivable days the subject, or by making receivables the subject, you get this particular formula I'm using here. Now the same thing applies to inventories, but for inventory I'm going to use cost of sales instead of revenue. So I'll have my inventory days multiplied by my cost of sales, which I would have to bring my minus here, divided by 365 days. So I have that there, and then I can calculate my total current assets here using Control R by copying the formula across, and my total assets as well, Control R, which is actually the total current liabilities added to our total non-current assets. So let me input my border. Alright, now we have the shareholders equity portion of the balance sheet. So for our share capital, we are going to assume that, so we can actually put here notes. So I can actually come here and then I can write notes, okay, so that we can actually be making some notes here to explain some of the assumptions that we haven't made in the assumptions column. So I'll come here and then I'll say that this is going to remain unchanged. So this is going to remain unchanged from the previous year. All right, and then for my long-term debt as well, I'm going to say it's going to remain unchanged. So remains unchanged. So I have that there. So for this, I'm going to just refer to my previous year. Now these are hard-coded figures, so they should all be in blue. I don't know why they are still in black here. So what we do is that all hard-coded figures in financial models are supposed to be formatted in blue. So all of these are supposed to be in blue except the formulas. So what I can do is, in order to select all my constants, I can just come to F5, go to special, then I'll go to special, I'll come here, select constants, and then I'll exclude texts, I'll exclude logicals, I'll exclude those items, errors, and then I'm going to select only numbers, and then I'll click OK. It's going to select all the numbers that are hard-coded for me, and then all I have to do is to select this, and then it's going to highlight all of them as in blue for me. So that's exactly what I want. So for my retained earnings, I'm going to calculate that from the retained earnings schedule. The retained earnings schedule. So we are going to leave that also as well. However, I can copy the total here across. And for my long-term debt, as I said, it's going to be unchanged. So I can copy this across. And now that I have gotten my long-term debt, I can go back to my statement of profit or loss or the income statement to complete the interest expense column. So I can come here and then I can select my interest expense, which is the long-term debt which we have here, multiplied by the interest expense assumption, which is as a percentage of long-term debt. So I can multiply that, and then I have this. However, I'm going to put it as a minus. So like that, copy this across, Control R. Now if you are wondering how I was able to change the negative numbers into brackets as we have in accounting and finance, you can just go to Control 1, and you see you have currency here, and you can reduce the decimal places to 0 as I have already done, and then I'll select my negative numbers to be in brackets. As you can see, if I want them to be like this, I'll select this one, but this is brackets. If I want them to be in red, like that, but I want them to be black font and they should be in brackets. So that is how I did that. All right, so we have everything selected here. Then the next thing here is the accounts payable, which can be forecasted as with dates inventory or the inventories. So I'll come here, go to the assumptions, pick my payable days, which is 36 days here, multiply that by my cost of sales, and then I'm going to divide that by the 365 days as we have here, and then I'm going to copy this across as well. So we have that, and I'm going to copy all of this across here, and then we have a check here. So I'm going to copy my check across. So as you can see, there is a difference. So always, to make your model robust, to make your model error proof, we always check for errors. So as you can see, the check I have input here is checking for the balance sheet difference. Now I'm going to put that also at the bar here, so that at any point in time I know exactly what I am doing. So I can put here check. So I can actually put the check, and I'm going to change the format, the font color to white, Sorry. So I can come here and change the font color to white. Do the same for all of these to white. And then I'm going to input an if statement here. So I'm going to say equals if. I'll use my tab key to select the if, and then the first one is a logical test. What's the logical test? The logical test is saying that if the absolute, so I can see absolute has come, so I'll use my tab key to select it. If the absolute difference between our total assets, so the absolute difference between our total assets and the total liabilities plus equity. So we have the absolute there. I'll close the parentheses for absolute, and then I'll have is greater than 1, comma, that is the logical test. So we are saying that if the absolute difference between the total assets minus the total liabilities is greater than 1, then what you are saying is that there is an error. There is an error. Otherwise, so value if false, value if true, then it's an error. If it is false, that means the difference or the absolute difference between total assets and total liabilities and equity is not equal to 1 or is not greater than 1. Then we are saying that it is okay. It is okay. So I can come here. So I haven't closed my formula, so I can come here and then I'll close my formula. So I'm going to close my formula. I'll hit enter. So you can see this is okay. Sorry. So we have okay right there. So you can see okay here, and then I'm going to copy the formula or the function across. So we are seeing okay for the other ones, but error for this one. Why? Because I have not copied my values across the entire balance sheet items. So I'll come here, select everything here, and I'm going to copy it across using Ctrl R. So as you can see, we have error here because we have not yet completed the balance sheet yet. So let me insert this here. I don't know why it's not inserting. So let me insert a border here. Alright, so we have that. So the items left here are the cash and cash equivalents, our retained earnings, as well as, alright, so those are the two items that are left. So we have our cash and cash equivalents as well as the retained earnings left for us to forecast, and then the cash flow statement. But before that, let's go to the supporting schedule, and we are going to build the PPE schedule. So I have my PPE schedule here. So I have my PPE schedule. And then the first item we will have here is the opening balance. Then we'll add or we'll less depreciation. So this is depreciation, and then we'll add capital expenditures, or what you call capex, to get our closing balance right here. Alright, so that is our PPE schedule. So the first value here, the opening balance, will actually be calculated. Now the closing balance is the balance within our statement of financial position or the balance sheet. So I'll come here and come and pick with the value there. So that is our PPE value. I'm going to copy it to the rest of the items here. And for my depreciation, I can find that within the income statement. So I'll come here, I'll go to my income statement and pick the depreciation expense. I'm going to remove the negative figure there. And for my capital expenditure, I can find it within my statement of cash flows. That is why we have additions that we have here. I'm going to remove the negative there. So that is it. And then the opening balance can be calculated from these three figures. So the opening balance will be equal to my closing balance added to the depreciation, and then I'm going to subtract the capex. So I have that. Now when you come here, this, so I can copy this particular depreciation because it is the same for all of them there, as well as my capex. So I can copy that one too across, and I can the formula from here to across. Alright, so and as you can see, the closing balance of the previous year becomes the opening balance of the next year. So the previous balance becomes the opening balance for the next, as you can see there. And then the applies here, assumption applies here. So I'll come here, the opening balance for my 2023 forecast period will be the closing balance for my actual 2022 figure. So that is it. And then for the depreciation, I have already calculated that, and that can be found within the income statement. So I'll come here, select this, and I'm going to remove my negative figure there. And the closing balance can also be found within my statement of profit or loss, my balance sheet. So I'll come here and then I'll pick my balance sheet, property, plant and equipment, as we have there. And then with these three, I can forecast my capex value. So the capex is going to be the closing balance. I'll add my depreciation, and then I'm going to subtract the opening balance, and that is my capex. So that is my capex. I can copy everything here across. So that is it for the PPE schedule. So with this, we can be able to pick any value we want here for our purpose. Now the next item we want to find here is the retained earnings. So I have my retained earnings here. So I have my retained earnings. So you have my retained earnings. For the retained earnings, I have my opening balance. I'll have my profits for the year, or the net income. So the profit for the year, and then I'll have my closing balance. So we have closing balance here. Then this is opening. So we have that. So for the opening balance for my PPE schedule, I'm going to calculate that using this, the closing balance minus the profit for the year. So that will be the opening balance. Now, what is the profit for the year? I can find that within my income statement. So I'll come here. Profit for the year is this. I'll link that. And my closing balance is the retained earnings within my balance sheet. So I'll come here, the balance sheet, where is my retained earnings, locate my retained earnings here, and then I have that. So I can copy this to the 3 years of forecast here. Now, when it comes to the forecasts, the same logic applies here. The opening balance for the forecast year 2023 becomes the closing balance for the actual year 2022. Profit for the year, I have already calculated it, or we already found it. That is within the statement of profit or loss or the income statement. So I'll link that up, and then this is going to be equal to the sum of the two. So I'll have alt equals, and that's going to sum everything for me. So I can copy everything across. You are free to rewatch this particular video again and again to have a full grasp of whatever we are learning in this particular video. So we have that, and then the next thing I want to do here is actually useful for the preparation of our cash flow. So what I have is the changes in our working capital. So changes in working capital. The three items that make up the working capital are accounts receivable. So you have our accounts receivable, we have accounts, we have our inventory first, and we have our accounts payable. So we have our accounts payable. As I said, if you want to understand these things the more, then check out my video on ratios interpretation and analysis. I have a video that summarized all the accounting ratios, the useful or the most commonly used accounting and finance ratios. So you can check that out. I also have other videos, comprehensive videos on ratios analysis and interpretation. So you can check those out to be able to understand exactly what I mean by working capital and everything that we are doing here. So this is actually changes. So you can have here changes there. All right, so I'll have here so I'm going to have here my net change in working capital. All right, so when it comes to accounts receivable or these net working capital items, in terms of cash flows, whenever accounts receivable is increasing, the impact on cash is that our cash reduces because our debtors are not paying us quickly. And so whenever accounts receivable is increasing, our cash position reduces. Hence, we put it as a negative whenever it is increasing within our cash flow statement. The same logic applies to inventory, and the opposite is true for accounts payable, because this one we are the ones paying. So when it is increasing, it means that we are holding on to cash. We are not paying our creditors, and so we are holding on to cash, and that is increasing our cash position. So that is what we have here. So I'll come to my accounts receivable, and this is going to be equal to, I'll bring my minus, open parenthesis, and I'm going to my balance sheet here. For the balance sheet, I have my accounts receivable, the previous one, or the current year minus the previous. So that is the difference as a minus. I have that. For my inventory, it's going to follow the same logic. So I can actually copy this particular formula down. So Control D. And then for my accounts payable, the accounts payable is going to be equal to my current year accounts payable minus the previous year's accounts payable. And this is increasing. From the look of the two figures here, we can see that it has increased from the previous year to the current year, and hence it is enhancing our cash position. So we are not going to put a negative sign here, so it's going to be a positive figure. So we have that there, and then I can sum these three together, and then I have that. I can copy this across using Control R. So that is it for our net working capital. Alright, so we have everything underway. So I'm going to link or complete my balance sheet here first by linking my retained earnings, which I have already calculated. So this is my retained earnings schedule, the closing balance here. I'll hit OK, and then I can copy this across. Good. Now the only item left here is our cash and cash equivalents. We are doing so great. Please, if this is your first time on my channel, kindly subscribe to the channel and also consider hitting the like button. If you are enjoying this video, please consider sharing the video with others and invite them to join whatever I am sharing here with you. Alright, now the next or the last thing we want to do when it comes to the three statement financial model is the cash flow statement. So I'll come here. Everything is set for us to build our cash flow statement. So I'll come here. The profit after tax is the profit for the year, or the net income from our income statement. So I'll come here and link it. The depreciation expense is also from the income statement, so I'll go there. So I'll go to my income statement and link my depreciation expense, which I would have to put a negative sign in front to convert it to positive number. And for my net changes in non-cash working capital, that is what we have done down here. And I'll come here and come and link that. So we have it there, and then I can copy the formula here, which is the sum of these three items. So that's profit after tax, add my depreciation expense back, and then also adjust for the changes in our non-cash working capital. So that is the cash flow statement we are building. So I'm going to copy this across using Control R. Then for my additions, I'll come here and then I'll link it to the capex. That is the additions. So the capex is there, and this is supposed to be a negative figure within the cash flow statement because we are using money to buy our assets or acquire our assets. So it's supposed to be a negative figure, and that is an investing activity under the cash flow statement. So I'll come here and then I'll use Control R to copy the formula across, and then I can copy this also across. Then for my issuance of equity, the assumption is that we are going to assume that they are going to remain unchanged. So I'm going to refer to this particular cell here. I'm going to refer to this particular cell here, and then I can copy the total across, and then I can come here and then complete. So under the period, so for the period under review, we are saying that there will be no repayment of debt and there will be no issuance of additional equity. That is the assumption we are making. All right. Okay. Then we also have our cash. So if you like, you can come here and put this assumption here. So remains, you can say remains unchanged from the previous year. All right, so remains unchanged from the previous year. I can come that and then copy the same thing here. All right, so now that we have that, we can actually come here and calculate our cash used or generated in the period, and that is the addition of cash from operating activities, cash used in investing, and then cash used or generated from financing activities. So that is the addition of the formula bar here, bar here, bar here. It is the addition of the three items. So I can come here and then copy my formula across. So I'll come here and then copy my formula across. So let me select here, copy them across. So as you can see, the cash and cash equivalent at start is this is a corkscrew. We call it a corkscrew movement. So we have the cash generated in the period, which is the addition of the three sources of financing, cash flow statements, and the equivalent at start is the cash and cash equivalent of the end of the period of the previous year. So as you can see, we have 1,000, 211,000 and 2021A. That becomes the cash and cash equivalent at start 2022, and then we add that to the cash used or generated in the period to get our cash and cash equivalents at the end of the period. So now that I've calculated this, I can link that to my balance sheet to complete it. So if it doesn't balance and it doesn't balance, then there's a problem somewhere which we would have to correct. So error here at the top right here. Let's link the cash and cash equivalent at the end and see if our balance sheet will balance. So it doesn't balance, but let me copy this across using Ctrl+R, and then let's try to identify where the problem is. So I've come here. So we come to our cash flows, and we realize that, as I said, this is a corkscrew movement. So we can see that this year's closing balance becomes the cash and cash equivalent at the start of the following year. As this has not been updated as such. So I'll come here and I'm going to move this to that. So I can come here and then I'll copy everything across. So as we can see that our balance sheet has actually balanced. Now this is no longer a hard-coded figure, so I can come here and change it to black. All right, so this is what we have for our financial model. Now let's go to the discounted cash flow model. Now with the discounted cash flow model, we're going to use what you call the unlevered free cash flow. Free cash flow. So I'll come here and write unlevered. So that is actually unlevered free flow. Now with the unlevered free cash flows, we use the unlevered free cash flow because we are considering only the cash flows, or we are considering the cash flows that are unaffected by the capital structure of the business. So with the capital structure, we are talking about the mix of long-term debt and equity that is used to finance the operations of the business. So when it comes to the valuation purposes, we don't consider cash flows that are affected by the capital structure of the firm. That is why we use the free cash flows, which are unlevered. This levered is talking about leverage. Okay, this has the idea of leverage. So the leverage is talking about the mix of long-term debt in relation to equity and those things. So that is why we are using the unlevered free cash flow to value the business using the discounted cash flow model. So we have our unlevered free cash flow, and what we do is we calculate it by first of all having what we call the EBIT. So we have our EBIT, and the next thing we'll do is that we'll have our operating taxes. We have operating taxes we are going to subtract to be able to get what we call NOPAT, or net operating profit after tax. That is the NOPAT. So I'll come here. What is my EBIT? Now I'm going to do this only for my forecast periods. So I can copy this particular formatting here, select the entire portion of my unlevered free cash flow portion, and using the paste special, I can use T and then I'll paste it there. Alright, now let me quickly bring back my alright. So after getting our NOPAT, then we add back depreciation, or let me just shorten it, D&A, that is depreciation and amortization. In this case, we only have depreciation. We'll add back depreciation, and then we'll also consider the changes in working capital, and we would also have capex, and then finally we'll have our unlevered free cash flow. So that is how we calculate the unlevered free cash flow. So let's see how that is going to be calculated. So we have our EBIT, which is interest and earnings before interest and tax. So I'll go to my income statement and I'm going to link the EBIT value here. And then for my operating taxes, that is going to be the income tax expense also within the income statement. So I'll come here and then I'm going to link it there, and I can have a sum of the two. So alt equals to sum the two, and I'll have my depreciation added back. So I have my minus here. I have my depreciation, which is also in the income statement. So I'll come to my income statement and then I'll link my depreciation there. Changes in working capital, which I have already calculated here, so I have that there. And then my capex, which is also in my PPE schedule, I can also put that there. And I want to make it a minus, so put my minus here, because capex always reduces our cash position. So I can have alt equals to sum them. So I can sum all of these together, and then that will give me my unlevered free cash flow. And then I can copy the formula to the right. Alright, now we have what we call valuation here. So let's look at the valuation. How are we going to make use of the unlevered free cash flow? So the first thing we'll have is we have an assumption here. So let me first of all let me put this assumptions. So for the assumptions, so we have assumptions. For the assumptions, I'm going to put it to the right here, right? So we have our assumptions, and the first one is WACC, and then we also have a small g here, a small g. Now the small g, the WACC, is the full meaning of WACC is the weighted average cost of capital. Now those of us who are not very familiar with finance, or we are not deeply into finance, the WACC is actually a very key financial term, which means the weighted average cost of capital. This particular cost of capital, or the rate, considers the capital structure of the firm. All right, so we are talking about the rate of interest that we can apply to both equity and debt. All right, so it is calculated using equity and debt, but in this particular scenario we don't have enough information to calculate our WACC, so we can actually assume some figures. So for the WACC we can assume that this is 10%, and then for my growth we are saying that at the end of this forecast period the business would generally grow at 3%. So that's the assumption you are making. That is the growth. The small g means the growth rate. All right, that is after the terminal value. We will get there. All right, so we have these two main assumptions that we have made here. Then what we want to do next is I'm coming to copy these particular years here. I'll copy them, come here, so I'll copy them, come here and paste special, paste only the value, so V, click OK. So I have that, and then I'm going to name them. So this is 1, this will be equal to this plus 1, so I can copy this across there. Great. So now that we have that, I can actually copy the formatting here, come here, so I'll copy the formatting here, come here and paste it, special format T. Okay, great. So we have that there, and what I want to do here is I'll have my unlevered cash flows, so I can cut it and then paste it here. So I'll have my unlevered cash flows there, and that will be equal to the unlevered cash flows that I have calculated here. I'm going to copy this across, and the next thing is discount factor, a discount factor. So what you are doing with the DCF model, what you are doing is that we have first of all calculated the cash flow that we need, and the cash flow we are using is the unlevered free cash flow. And I told you that the reason why we are using the unlevered free cash flow is because we want to consider the cash flows that are not affected by the capital structure of the firm. Then after getting that, we make these assumptions for WACC and then the growth, and then the next thing we do is to discount this. These are future cash flows. These are cash flows we are expecting to generate from the business into the foreseeable future. All right, so we want to value the business in the present. We are talking about what is the value of these future cash flows in today's terms. That's what we are doing. So to be able to do that, we use the discount factor to do that. Now you can also use the NPV formula within Microsoft Excel, which is an inbuilt formula, to be able to do this. However, there is a problem, and you are going to find out very soon. So we have that. So we have our discount factor, and the formula for calculating that is actually equals to 1 divided by, I'll open my parentheses, 1 plus my WACC assumption, which is 10%. I'll close my parentheses, raised to the power, so I'm going to raise that to the power the number of year here. So this is year 1. All right, so I'll close that, and I'm going to format it as a decimal. So this is supposed to be a decimal with 2 decimal places. That is good, and then I can format this across. Now let me fix the WACC reference so that it doesn't change whilst I copy the formula across. So using F4, I can anchor that, and then I can copy it across now. So we have our discount factor. Then we can have PV, present value of the unlevered free cash flows. So the present values are going to be equal to the future cash flows multiplied by the discount factor, and that will give you the present value. So when you multiply the discount factor by the future value or the future cash flow, then we get the present value of the cash flow. I'm going to format this as a currency with no decimal places there, and then I can copy this across. All right, now that we have this, we can come here, and I would want to calculate what we call the enterprise value. So I'll come here and then I'll calculate enterprise value as well as equity value. The enterprise value is talking about the market, just the market value of the business. The market value of the business, that's what we are coming to calculate. The equity value is talking about the value of the stake of the equity portion of the business. All right, what that part of the business that consists of equity, what is its value? That is what we are meaning here. All right, so when you look at it, I had a share price here. The share price, you are going to use the equity value here to calculate this share price here. All right, so don't worry, we'll go get there. All right, so the enterprise value, we start with the present value of the cash flows that we calculated. So the present value of our cash flows, and that is going to be the addition, or that is going to be the cash flow of this last year here. That is going to be the addition. So we have sum of all the cash flows that we have here. I'll close my parentheses and hit enter. And then the next thing we will have is what you call the continuing value. So after the forecast period what is going to happen, or how is our business going to be valued, or what will be the value of the business even after we have exhausted the forecast period, which is 2028, and that is going to be equal to this particular value here, the last unlevered free cash flow value. So the last value here, unlevered cash flow here, and we are going to multiply that by 1 plus my growth model, the growth rate or the growth rate assumption, which is 3% here. I'll close my parentheses and divide that by my WACC minus the growth rate again. So this is how we calculate the continuing value of the business. We will pick the unlevered cash flow, free cash flow, and we are going to discount that using these two values here. So we have 1 plus the growth rate, and we are going to divide that by the WACC, in parentheses the WACC minus the growth rate again. So I'll hit enter, and that is it. And then the next thing is to calculate the present value of the continuing value, and that will be equal to this particular value here multiplied by the discount factor, which is 0.56. So I'll multiply that, and then the enterprise value will now be equal to the present value of the cash flows, which is the unlevered cash flows, added to the present value of the continuing value, 400, that is $441,910. So that is our enterprise value, the market value of this particular business today. All right, this keeps changing. So we have that. All right, now we have the equity value. The equity value starts with the enterprise value. So we have our enterprise value, and that is equal to this particular value here. And then we would have our long-term debt from our balance sheet, and then lastly we would have cash and cash equivalents. Cash and cash equivalents. So what is our long-term debt? That is the long-term debt of the last actual period. So that is the last actual period of the business. All right, so and that is 2022. So I'm going to pick the long-term debt of the last period, and that is 30,000 right here. So I have that. And then for the cash and cash equivalent is the same. So I'll come here and pick my cash and cash equivalents for the last year of my forecast. So I have that. This is actually less the long-term debt, and then we add the cash and cash equivalents. All right, so this will be now be equal to the enterprise value minus the long-term debt plus my cash and cash equivalent, and that is my equity value. Now let's assume that total shares outstanding is 170,000, assuming that the total number of assuming that as of today the share price is $1 each. All right, so that is the assumption there. So let me reduce this to 0, and this is actually a number with 0 decimal places. I want to insert a comma here. It's 0 decimal places. All right, so and then this is a hard-coded figure, so I'm going to copy this, and all right, so this is a hard-coded figure, so I have to format it in blue. So I'll come here and I'm going to use this blue right here. All right, so we can say that our equity value per share, the equity value per share will be equal to our equity value here divided by the number of shares, and that is that. I'm going to format it as a currency with 2 decimal places. So currency has 2 decimal places there. So that's the equity value per share, and that is what I'm going to put right into this box here. So equals this particular value here, so that whenever my scenario changes, whenever I change my scenario, the equity value updates as such. So when we are on the upside case, we can say that the equity value is $5.84. When there is a downside, it's 2.75. When it is the base case, it is 3.83. So our model is working perfectly. It's working perfectly. So that we have for the valuation. So this is what we are doing here. So with the DCF model, this is how we calculate it. All right, so we have our WACC, and then we discount our cash flow projections into the present, sum them together, and that is the DCF model. That is all that you need to know about DCF model. Every other thing is just an addition. So with this particular case, we can actually add a sensitivity analysis. So let me copy this particular heading here. So I'm going to copy this and I'll put it right here, paste, and I'll name this sensitivity analysis. Alright, so with the sensitivity analysis, we can actually have two values here. We can put revenue growth here. So let me actually insert a text box. So I'll insert a text box here. Come here and then I can insert a text box here nicely, and I can say revenue growth, and I can fill the text box. I can fill it with this particular and increase this as well. Change the font color to white and put it at the center here. Great. Then I can even cut it. I can duplicate it, move it right here, so instead of revenue growth, I can say my WACC here. Alright, so I have my WACC here, and I can put my small g here. I can put it at the center, and I can reduce it right here, bring it forward here. Alright, so with the sensitivity analysis, what you're basically saying is that what if WACC changes to say 12% from the 10 to 8 or 7 or 6? How would our DCF model, or how would the value of the business change, or what would the value of the business be with respect to these changes? So that is basically what you are doing. So for the growth, we said we put it at 3%, right? So now let's look at 1, we are looking at 2, we are looking at 3, and we are looking at 4 up to 5. Alright, so I can bring this right here, reduce this nicely there, and then for my WACC, I can have, so we put it at 10, so I can send it back to 7, 8, 9, 10. So I think 7 is way too ahead, so we put it at 10, right? So let's, in case it changes to, let's say 8, 9, 10, 11, 12, and then 12. So we have these particular assumptions right here. Alright, so that is our WACC right there for us, and I'm going to bold these figures. So this is how we build the sensitivity analysis. First, in this particular corner here, we are going to input the value that we are going to sensitize. So which value are you trying to sensitize? The value you are trying to sensitize in this case is the enterprise value. So I can also pick the equity value. All right, let's use the enterprise value. So I'm going to come here, equals, and I'm going to put my enterprise value. Now that we have this, the next thing we want to do is to select everything here. So I'm going to select everything here and select this as well, and I'll go to data, come to the data tab, and then what if analysis. So I'll click that, and then data table here. I'll click the data table. Now the row input cell is the WACC assumption, which is 3% here. The row input cell is the WACC assumption here, and then the column input cell is the growth assumption that we have there. So I'll click OK, and you will see that the table has populated for me. And how do I know I am correct? So we have made a slight mistake here. So this are supposed to be in percentages. All right, so I'll come here, the home tab, and then I'll select percent. 8%, and then as you can see that as I'm changing these values, I can copy this across. So instead of 8, I can say 9. This is supposed to be 10. This is supposed to be 11. This is supposed to be 12. And then for my growth, it's supposed to be 1%. This is supposed to be, so I can copy it down, but this is 2. This is supposed to be 3. This is supposed to be 5. Sorry. So we have 5 there, and then this is supposed to be 4. So how do I know that I am correct? What is our enterprise value? This is 441,910, right? At WACC being 10, and then the growth rate being 3%. So let's look at where WACC is 10 and the growth rate is 3%. And then we can see that this is the growth rate is 3. This is WACC being 10, and then we have the same value here. All right, so I'm going to format it as currency with no decimal places. So as you can see, the same value that we have as our enterprise value right here is what we are having there. So I can even hide this particular number here. So I can come here and change it to white, so nothing can be viewing there. So this is how we add sensitivity analysis to our model. This has been a very long journey. Thank you for being with me to the end. I hope you enjoyed this video. I hope you learned a lot from this video. So in this video, what we learned is we applied our assumptions and drivers. We look at the setup, how to set up the discount or the financial model in general. We looked at how to calculate the assumptions and drivers, how to make our assumptions, our cases, how to apply data validation in our model, how to apply some formulas within our model, how to model the three-statement financial statements, or the three-statement financial model, sorry. And then we also went ahead to calculate the discounted cash flow model. We valued this business using both the enterprise value and the equity value. And our model is so dynamic. Whenever I change the scenario, it updates with a single click, and every value updates as such, and the balance sheet still balances. So this is how we prepare a full discounted cash flow model in Excel workbook. All right, and then we also added, finally we added sensitivity analysis to our model, so that in case our growth model reduces to 1% and the WACC reduces to 8%, we know that the enterprise value of this business will be around $280,000. All right, and then the same applies to all the other figures that we have here. All right, so the last thing we want to do is to actually group our cells. So as you can see, we have various headings. So I want the assumptions and drivers to be grouped. So I can come here and using my shift key, okay, first let me select this, and then I'll scroll down to the last assumption item, and then using my shift key, I'll select the entire cells. I'll go to the data tab, come to outline here and group, and then I'll say group. All right, then the next one I'll be doing, I'm going to use F4 to do it. So holding my shift again, I'll select, using the arrow, the down arrow key, I'll select the entire cells, and then I'll use F4 to repeat the last action. I'll come to my statement of financial position or the balance sheet and do same. So selecting everything here, using the shift and then the down arrow key, I'll select everything here and I'll use F4 to repeat the last action. I'll do same for all the other ones. So I'll come here, select this entire thing here. I'm going to do it for all the other cells. So F4. My supporting schedules are here, using F4 with the DCF valuation. Select everything here, and then I'll use F4, and then lastly I'll also group the sensitivity analysis together. So using F4. The last thing I didn't do, or the final thing I didn't do about this particular model, is to add graphs. And how to add a graph, I have already done that in a previous video, so you can check that out on how to add graphs to your model. All right, it is not different from whatever we have done in this particular model. So I'll use F4 to do that, and then to collapse the entire thing, I'll press 1 here, and then it will group everything for me. So this is my full financial model, as you can see here. Very, very, very dynamic. So let me come here and select my scenario 1. So that is it for this particular video. Remember, I have hidden the Excel grid lines. And how did I do that? I came to View tab, and then I unselected the grid line. So when I select it back, you see that the grid lines are back. When I unselect it, then they are gone. All right, so that is actually a very good practice when it comes to financial modeling. So thank you very much for your time. I hope you enjoyed this video. Please subscribe to the channel if this is your first time on my channel. Then my next video is going to be on budgeting and forecasting. So be on the lookout for my new videos, and I'll see you again in that particular video. Till then, it's a bye for now.